If I gave you $10,000 right now, and you had to choose between an ETF or a mutual fund, one choice could quietly cost you tens of thousands of dollars over your lifetime. And most people, even smart investors, pick the wrong one. So today, we're ending the debate once and for all. ETFs versus mutual funds. What's actually better? No jargon, no bias, just the truth. Let's strip this down. Both ETFs and mutual funds do one thing. They let you buy a basket of investments instead of picking individual stocks. Instead of betting on one company, you buy 500 or 3,000 or an entire country. Take the S&P 500 as an example. You can buy it as an ETF like SPY or VOO, or you can buy a mutual fund version of the same thing. So if they both hold the same stocks, why is this even a debate? Because how they're built changes everything. Here's the core difference most people don't understand. ETFs trade like stocks. You can buy and sell them throughout the day. The price changes every second. Mutual funds price once per day. You place your order and you get whatever the price is at market close. That's it. Now you might think, okay, that doesn't sound like a big deal, but it becomes a big deal in volatile markets. During crashes, ETF investors can react instantly. Mutual fund investors are stuck until 4 p.m. During hype rallies, ETF investors can jump in immediately. Mutual fund buyers have to wait. Is that good or bad? It depends on your personality. If you're emotional, ETFs give you the ability to panic. Mutual funds force discipline, and that is underrated. Now let's talk about money, because this is where things get serious. Historically, mutual funds charged higher expense ratios. Some actively managed mutual funds still charge 0.75%, 1%, even 1.5% annually. That sounds small. It's not. If you invest $500,000 over time, a 1% fee difference can cost you over $100,000 or more in lifetime returns. ETFs, on the other hand, many cost 0.03% or 0.05%, dirt cheap. That's why low-cost index ETFs exploded in popularity. Lower fees mean more compounding in your pocket. And compounding is everything. Here's where people get emotional. Most mutual funds are actively managed. That means a fund manager is trying to beat the market. It sounds great. But here's the uncomfortable truth. Over 10 to 15 years, most active managers underperform the index after fees. Not some, most. ETFs are typically passive. They just track the index. No ego, no bets, no stock picking, just math. And historically, boring math wins. But there are exceptions. In niche markets, small caps, emerging markets, active managers sometimes outperform. The problem is, you have to pick the right one in advance. And that's harder than it sounds. Now this part is huge, especially for US investors. ETFs are generally more tax efficient. Why? Because of how they're structured. When mutual funds rebalance, they may distribute capital gains to investors, meaning you can owe taxes even if you didn't sell anything. ETFs use a mechanism that often minimizes those taxable events. The result is fewer surprise tax bills. For long-term taxable accounts, this matters. In retirement accounts like 401ks or IRAs, it doesn't matter much. Location matters. Now let's talk about accessibility. Mutual funds sometimes require $1,000 minimums, $3,000 minimums, sometimes more. ETFs, you can buy one share, or even fractional shares. That accessibility is why younger investors gravitate toward ETFs. It feels modern, flexible, liquid. Mutual funds feel old school. But old school doesn't mean bad. Here's the part no one talks about. The best investment isn't the one with the lowest fee. It's the one you won't mess up. ETFs trade in real time. You see the price moving, you can check it every minute. That can trigger panic selling, overtrading, emotional decisions. Mutual funds? You don't see the drama, you invest, you wait, you move on with your life. For many investors, that's a feature, not a bug. The biggest enemy of returns isn't fees, it's behavior. So which is better? Here's the honest answer. For most long-term investors in the US, UK, Canada, and Australia, low-cost index ETFs are usually the most efficient, flexible choice. They're cheap, tax-efficient, transparent, and easy to trade. But mutual funds are not obsolete. They can be better if you want automatic investing simplicity, if you're inside retirement accounts, if you prefer discipline over flexibility, or if you have access to ultra-low-cost institutional funds. It's not about better, it's about fit. So ask yourself 3 questions. Do I want flexibility and control? That points toward ETFs. Do I want automation and less temptation? That points toward mutual funds. And finally, am I obsessing over tiny differences instead of just investing consistently? Because that's the bigger problem. Here's the truth. Consistency beats optimization every time. ETFs versus mutual funds isn't really a finance question. It's a behavior question. The difference between them might be 0.5% per year, but the difference between staying invested and panic selling during a crash can be millions over a lifetime. Choose the structure that makes you stay calm. That's the one that makes you rich.